this class we discussed some important concepts with related to financial awareness and banking, wherein the banking forms the very important element for number of exams, including POs, clerks and others. Now, how to study the chapter banking? So here, the banking should be mastered in 3 steps. Firstly, introduction, banking in India and latest trends in the banking. So the questions can fall only in these 3 areas. So any question from banking can be fall into 3 categories only. Firstly, a general introduction type, or second, with related to the structure of banking in India. Third, latest trends or developments in the banking sector. So we have to sure what type of questions it is. Then starting the introduction of the banking, first of all, one has to know some fundamentals in the banking area. Firstly, what is the definition of a bank? What are the various types of banking? And what are the important functions of banking? The term bank is derived from the Italian word banca, and in the French, the word bank means a payable or support from the, say, in the French word. So, with this Italian and the French words, the term is taken. Then, according to India, that is the Indian Banking Act, Banking Regulation Act 1949 defines banking means accepting for the purpose of lending or investment of deposits. So, first important character is the institution should accept the deposits. The accepted deposits may be for lending or for the investment or otherwise. Then it should accept from money from the public and repayable on the demand. Unlike the other non-banking finance companies, where the NBFCs cannot give the money on the demand, this is one of the aspect of the banking. Next, withdrawal by the check. This is another important area. The institution can give the check on its name. This is absent in the non-banking finance companies. These 2 important aspects. Nextly, draft and the transactions will be made by the check, draft, order or otherwise. So, when these characters are present or these features are present, then only an institution can be described as a banking. Then when coming to the in history, what are the various types of banking? In the Bank of Venice was the primitive bank dated in the history, which is the oldest commercial banks. And before the organized and commercial bank systems, there are other forms of banking processes, namely the goldsmith, the money lender, and the trading merchants. These are the 3 important elementary forms of the banking available anywhere in the world. Then types of banking: unit banking and branch banking. Unit banking means only one branch will be there in the entire economic system of the country. Branch banking means the same bank will be in different branches. Mixed banking and social banking. So mixed banking means bank lending all types of loans, and social banking means 2 or more banks say they have the social and programming goals. So likewise, in the types of banking, there are a number of types of banks depending on the various types in which the economy is operating, meaning scheduled banks and non-scheduled banks, commercial banks and cooperative banks, then regional rural banks and the private sector banks. Likewise, the types of banking differ in the systems. Secondly, whatever may be the types of the banking, the commercial banks will have primarily 2 important functions. One is the primary functions, the other is the secondary functions. And the primary functions are, as I defined in the bank definition, acceptance of the deposits, and these deposits can be demand deposits, fixed deposits, and the savings deposits and the current deposits. Then besides this, there are also time and recurring deposits. Then another important function, primary function, is the granting of the advances. The granting of the advances is the another important function of the bank. Granting the advances, overdrafts, loans, cash, credit and discount of the bills, these remain the primary functions of the bank. Then besides this, the bank will also perform the secondary functions, which can be categorized firstly into general utility functions. General utility functions are the locker facility, collection of the various statistics, and implementing social welfare programs on the behalf of the government, transfer of the funds, purchase and sale of the foreign exchange, likewise. And there are also representative functions representing the institutions and the collection of the checks like LIC, then the LIC premium payments, then debentures, bonds, distribution. So all these functions, they can be categorized into representative functions. So altogether the primary functions and secondary functions combinedly will have 4 types of functions: accepting deposits, advancing loans, then the implementing the utility functions, then the representative functions. These 4 will remain the core important functions of any bank in any country. Then banking in India, how to study as I told you the first introduction chapter, how to a fundamental aspect of the banking is required, that we have already studied. Then the most important and the number of questions in various examinations are primarily asked from this area, that is the banking in India. And how to study this banking in India? First, one has to know what are the various important acts, evolution of the Indian banking system, the central bank, its role and the functions, the structure of banking system in India, process of nationalization, types of banks, and what are the various banking sector reforms and other important miscellaneous topics related to the banking. So this is all set together 8 sub areas or the sub chapters are there in mastering the system. First we take up the important acts in the banking. So the banking in India will have the number of acts, but prime acts and the important acts are the RBI Act 1934. So this RBI, primarily when you go back say to the history, the 3 imperial banks which were merged, they were also provided the reserve treasuries to supply the funds through the government say to these banks. Then up to 1934 the RBI is primarily controlled by the private sector, and after promulgation of the RBI Act 1934, the central bank was established initially at the Calcutta, then later the headquarters shifted say to the Mumbai. Then say in the 1949 2 important developments took place. Firstly, RBI was nationalized. As I told you earlier, before the nationalization, the RBI was not completely under the public sector, and in the 1949 only the RBI was nationalized completely. Besides this, after nationalizing, the Banking Regulation Act 1949 was made, and all the supervisory functions of these banks were given the supervisory functions set to the RBI. Then the SBI Act 1955, where the imperial bank was changed into the State Bank of India. Then these subsidiaries in the princely states, they were also nationalized. Then to cater the needs of the banking functions of the rural areas, agriculture, small and marginal farmers and others, regional rural banks were established in 1975 by the act known as the Regional Rural Banks Act 1976. However, initially there was an ordinance, later it was replaced by the act. Then SARFAESI Act, where the banking will have the important functions to recover the important debts from the debtors. So these are the various important acts one has to know in detail. Then dating back to the history of the banking. History of the banking can be divided into 4 important phases. That is the historical phase, that is from early times up to the 1770. Then later from the early phase that is 1770 to 1969, before nationalization. Then nationalization phase 1969 to the 1991. Then the reforms phase from 1991 to the till date. Now we will have a look at the historical phase. So in India, when we date back the history, money lending activity is traced even in the Vedic period from 2000 to the 1400 BC. The existence of the professionals lending the money is there, could be traced say to the 500 BC. And in the Kautilya's Arthashastra has contained references to the creditors, lenders and other lending even rates are also mentioned. Hundis are the oldest credit instruments. They are dated back even in the 12th century AD. So deposits were accepted by some indigenous banks known as the Kataputta system, and many important indigenous bankers like Multanis, Marwaris, though they did not accept the deposits, but they are the people who will lend the primarily a lending activity in the system. Then the early phase, so that is the from 1776 to the 69, what we known as early phase. But before that, the first bank of the joint stock company variety of the bank in the was established in the 1720 in the Bombay. This was followed by the Bank of Hindustan in Calcutta in 1770. However, the bank was closed in 1832. Then General Bank of Bengal and Bihar was established after the Bank of Hindustan, though it was short-lived. Then the Bengal Bank came into existence in the 1784. The General Bank of India was established in 1786. And there is also a reference that in the southern region, a Karnataka Bank was established in 1788. So in the examination point of view, whenever the question is asked, the first bank or was the Bank of Bombay, initially established in 1720, and a fully what you call commercialized bank is the Bank of Hindustan, established in Calcutta in 1770. Initially, much of the banking activity was centered around Calcutta. One has to note this point. Then the presidency banks established by the East India Company, particularly in these three important areas, namely the Kolkata, Bombay and the Madras. So the first presidency bank was established in the Bengal region in the Calcutta with the capital of 50 lakhs, later in the Bombay in 1840, later in the Madras in 1843. And this new Bank of Bombay was established in the 1868 besides these three presidency banks. It is heard that the presidency bank in Bombay is not worthwhile functioning in those days. That's why there is a need of the new Bank of Bombay was arranged in 1868. Then in 1876, the Presidency Act has made some restrictions on the presidency banks. They made some important controls. Reserve treasuries, as I told you earlier, was established in both Calcutta, Bombay and also in the Madras to fund these banks. It is a primitive form of the central bank. Then in 1865, Allahabad Bank was formed, which is the first Indian owned bank and which is also known as the oldest bank in India. And later once the formation of the establishments of the bank was picked up. That was the Bank of Upper India, then a Bank of Oudh and Punjab National Bank, Bank of India, and later in the 1906 with the Swadeshi movement, number of Indians started establishing their own banks. So this Swadeshi movement has gave impetus to the economic development. Now the number of banks are Bank of Baroda, Canara Bank in the southern region, Indian Bank and Bank of Mysore. So these are all were established. The Central Bank of India was wholly owned and managed by the Indians. And influenced by the Swadeshi movement, you are also started the lending and accepting deposit activity in the cooperative sector. In 1889 itself, there is a first cooperative credit society was formed in the Kanjivaram, and later in the 1905 in the Bengaluru the cooperative society was formed. Then there is some reforms were introduced in the British India with the Hilton Young Commission in the 1935, and in the 1949 Banking Regulation Act was enacted, and all these three imperial banks were amalgamated into the 1921, and number of banks were also merged in the Imperial Bank of India. Then as per the recommendations of the Hilton Young Commission, the RBI was established in 1934. It was nationalized in the 1949, and the Banking Regulation Act giving the supervision of the RBI said to all the banking activities in India was made in the 1949. So then all the Imperial Bank of India and their merged banks were named as State Bank of India, and it was nationalized. And in 1959, the subsidiary banks which were in the various princely states, Travancore, Mysore, Hyderabad, Indore, Patiala and others, all these were nationalized in the 1959. And in 1963, there was a small change. The State Bank of Jaipur and the State Bank of Bikaner was merged to form the State Bank of Jaipur and Bikaner. Now the subsidiaries were only 7. And in 2008, State Bank of Saurashtra was merged with the SBI, reducing the subsidiaries to 6. And in 2010, State Bank of Indore was merged with SBI, reducing its subsidiaries to 5. So this is the important development in the SBI and its functions. Then we will enter into the second phase, that is the nationalization phase. In the nationalization phase, the important the banks were given the social control and the social responsibility, and a part of that the 14 banks with the deposits of over 500 crores, they were nationalized in the 1969, and these are the some of the banks. And later the second step of nationalization, before that there is a regional rural banks were established to cater the needs of the small industries and small entrepreneurs, small and marginal farmers and others. These RRBs were expected to combine the rural touch and local feel with the modern business enterprising activity. Then before this nationalization, the banks were also given some type of approaches, namely the lead bank approach, the district approach in 1969, and in 1988 service area approach was given. Then in the nationalization phase, they continued in the second phase, where the 6 banks were nationalized with the liabilities of or the deposits of the 200 crores. Now, as on the 1990, the number of nationalized banks are 20, and the SBI and all together with associates, and the figures comes to the 28. So, but as I told you earlier, the Indian economy has undergone reforms, and as a part of financial and banking sector reforms, number of companies were levied on the banking sector, of which the prime important companies are the Narasimhan Committee 1 and Narasimhan Committee 2, and besides which you will also had the number of reform process has took place. Here during the reforms phase, there is a change in the number of banks. Here this is a very important for the examination point of view. In 1993, the new Bank of India was merged with the Punjab National Bank, reducing the nationalized banks set to the 19. Here friends, the terms nationalized banks and the SBI and its associates are different. So far the RBI nomenclature is concerned. And the public sector banks are the banks with which the government will have the more than 50% share. So generally nationalized banks, the term will apply to the 2 phases of nationalization as far as RBI norms are concerned. So one should be very careful while using these terms. In 2004, IDA Bank was nationalized, and in the 2013, Bharatiya Mahila Bank was nationalized. Now the nationalized banks, their figure went up from 19 set to the 21. From 20, New Bank of India was reduced. Now the figure came to 19. Then later, IDBI Bank and Bharatiya Mahila Bank. So with these nationalized banks, it became 21. And as I told you, the SBI and its associates, though their figure is 7 from 8, so in 1959 it is 8. And later in 1963, the subsidiary banks of merged State Bank of Bikaner and the State Bank of Jaipur were merged to form one banking set, that is the State Bank of Jaipur and the Bikaner. But now in the 2008 and the 2010, these 2 banks, associated banks, were merged with the SBI, taking the SBI Associates Bank to 5. So SBI plus its 5 associates now comes to the 6. So and these 6 plus the nationalized banks 21. Now the public sector, the major public sector banks in India are the 27. This figure is very important for examination point of view. Then the Reserve Bank of India, which is the prime important controller of the entire banking system in India, we have to discuss about the RBI. As I told you, the primitive form of the Reserve Bank of India or the Central Bank of India is the reserve treasuries existing in the British time, where these treasuries, they have supplied some money on the behalf of the government to the 3 imperial banks. So this is like a primitive beginning of the central bank. And in the 1934, the act was made as per the recommendations of the Hilton Young Commission, and later it was RBI or the central bank was established in 1939, Reserve Bank of India, and later initially the headquarters was Kolkata, later shifted to the Mumbai. It was completely nationalized in 1949. Then during the establishment, the first RBI governor is Osborne Smith, and after nationalization, C.D. Deshmukh continued as the governor of RBI. And at present, as you are aware, the Raghuram Rajan is the RBI, Reserve Bank of India, the governor. Then the functions of the RBI. So this RBI as important functions, and it controls the entire banking and lending activity in the system. And primarily these functions can be categorized into general functions and the specific functions. RBI itself acts as the bankers say to the bank, meaning all the commercial banks in India, they have to keep certain deposits say with the RBI, that is it acts as a bank. So generally the lending and accepting deposits was between the people and the commercial banks on one side, but the bank themselves will lend and accept the deposits or the money from the RBI. That's why it is known as bankers bank. It is known as bankers say to the government because the RBI on the behalf of the government, it will act as bankers say to the government. It performs all the banking activities of the government on behalf of the government. So that's why it is called bankers say to the government. And it is the sole custodian of the foreign exchange rates and the activities in India. However, after the reforms, these functions are delegated to many banks, but the rates were primarily determined by these RBI. And the credit supply and the money flow, which is the very important in economic system, these are under the control of the RBI. And through its monetary policy, it controls the money supply and the credit flow say to the various sector in the economy. And the specific functions can be categorized into two types, namely the quantitative functions and the qualitative functions. Qualitative functions, of which there are the three important primary functions in the initially existing, that is the bank rate. Bank rate is the rate at which the RBI lends the money say to the commercial banks. As I told you, it acts as a bankers say to the banks. So it is the rate at which the RBI lends money say to the or the lends deposits say to the commercial banks. Then statutory liquidity ratio. These commercial banks, even after collecting their deposits from the public, they have the function of lending the collected deposits say for the interest rates. But here the RBI has made a clause that all the money collected, all the deposits collected, of which certain percentage of the collected deposits is to be in the liquidity form. So far in the initial stages, the liquidity forms are only two types, namely the gold and the money or the cash. But later the government securities were also added as an important form of the liquidity. So whatever the banks collected deposits, of which certain percentage is to be in the liquidity form, and the ratio was determined by the banks. At present it is 21.5, it is the SLR prevailing. Then the cash reserve ratio. Cash reserve ratio, certain part of the cash the banks collected, they have to deposit with the RBI, as I told you. So this is it acts as a banker say to the bank. Through the SLR, through the bank rate, RBI lends the money, and through the CRR, RBI accepts the deposits from the commercial banks. So likewise it acts as a banker say to the bank. And the cash reserve ratio, certain part of the deposits collected by the commercial banks has to deposit with the bank, and this is very important. Before reforms, the CRR is very high, but after the reforms, the CRR was ranged between 3 to 15%, and at present it is 4 and plus percentage. Then after the economic reforms, three important aspects were introduced, namely the repo rate, reverse repo rate, and marginal standing facility. So the repo rate is the rate at which, so if the entire process in the entire process of the banking system with the high BR, high SLR and the high CRR, banks have some problems of the money say during the emergencies. So whenever say there are certain emergencies, banks can also take the deposits, or the banks can resort say to the lending activity from the RBI through some interest rates known as the repurchasing rate by the through the transactions of the government securities. This rate is known as the repo rate. Then repo means repurchasing rate. So the RBI will takes the government securities and lends the certain money to the commercial banks on the pre-agreed determination of the repurchasing of the government securities, which was given initially by the banks say to the RBI. Later it will be purchased from the RBI say to the banks, and this rate is known as the repo rate. And whenever the commercial banks are having the more deposits, then the RBI, instead of flowing into the unproductive sector, RBI takes absorbs the liquidity from the banks through a rates known as reverse repo rate. The repo rate and reverse repo rate operate in the economy system, say through the process of the government's securities to absorb the liquidity and to pump the liquidity. So whenever say there is a shortage of liquidity in the system, through the repo, the RBI injects the liquidity. Whenever there is a excess liquidity in the system, through the reverse repo rate, the banks will absorb the liquidity, say the RBI will absorb the liquidity from the banks. And this entire process will takes place through the government securities. And the lastly, the marginal standing facility. Marginal standing facility is the facility which is very temporary and which is the very short term liquidity adjustment facilities, LAFs. These are known as liquidity adjustment facilities. And the marginal standing facility is for very short term, that is less than 1 day, where the banks can lend the money from the RBI at a very shorter duration period, and the MSF lending will also depends on the deposits and the turnover of the banks. So these are the quantitative aspects which regulates the commercial banks through its bank rate, SLR, CRR, repo rate, reverse repo rate, and the marginal standing facility. Then the qualitative functions. So the commercial banks, say on the commercial banks, the RBI is also having certain controls, say, and it controls the measures, say through the qualitative measures also. Marginal requirements. What are marginal requirements? The banks will sometimes lend the deposits through the pledging activity, and the margin of the market value and the amount lended to the customer is known as the margin, and this margin will be decided by the RBI according to the inflation and according to the liquidity and according to the economic activity prevailing in the system. The margins are determined by the RBI. Then moral suasion. The RBI will constantly guides the commercial banks like a friend, like a philosopher and a guide. It will always persuades the bank not to lend the activities for the unproductive sector and to give the money set only set to the priority sector, so that the economic growth can be better achieved. And the credit rationing. So as far as the credit lending activity is concerned, the commercial banks, as and when required, they cannot give the credit say to the one sector or say to the one person. RBI directs the commercial banks like the priority sector lending or the top priority sector activities. Likewise, it will have the credit rationing on the commercial banks. And lastly, if the RBI, when the marginal requirements were determined, moral suasion and credit rationing, if the commercial banks are not heard of, then the RBI takes direct action on the commercial banks. So through these qualitative measures and the quantitative measures, the entire commercial banking activity in the India or in the economy is controlled by the RBI. Then the general functions, as I described earlier. So the sole custodian of the RBI, and besides which the RBI is also having some other functions, meaning besides the providing the credit and monetary supply, RBI also performs some developmental programs which is very important. RBI, by subscribing capitals to the number of agencies, namely the NABARD, National Housing Bank, and a number of other financial institutions, RBI will also participate in the developmental activities of the banking system in India. So here I want to reiterate the RBI, besides performing the general functions and the qualitative measures and the quantitative measures, it also performs the developmental measures by the RBI. Besides which, it also has the specific functions as I described earlier. So in this class we have described the general functions of the RBI and the evolution of the history of the banking in India and the various important acts which are prevailing in India for controlling and the operation of the commercial banking activity. So and we also described the process of the nationalization of the banks in India. Now what are the various types of the banks, namely the commercial banks, the scheduled banks, non-scheduled banks, cooperative banks, private banks, foreign banks, and the cooperative structure in India. What is the village level cooperative bank, namely the PACs, and how many number of acts are there are to be discussed under the types of banks. And after 1991, number of reforms were taken in the financial sector, including the banking sector, and those are to be described in the banking sector. And what are the other important developments, and what are the various banks, their logos, their slogans, all these will be discussed under the miscellaneous functions. So of the 8 important activities in the banking in India, we have completed the important acts: history of banking, role and functions of the RBI, structure of the banking in India, and we have to discuss in detail what is the exactly the structure. We have finished the nationalization and the types of banks and the structure, banking sector reforms and miscellaneous. This we will take up in the next class. Thank you.